Hey everybody, thank you so much for checking the channel out today. My name is Agabus. This is your financial education channel, and today we're learning about investing basics. Today we're going to take a look in regards to risk when it comes to your principal. Some ideas to consider when it comes to low risk places to put your money. Low risk meaning you don't lose your money, and some high risk places where you could lose your money but also maybe get some sort of return. When you're thinking about investing, it's really just money placement, or where are you going to put your money. Of course, this channel does not recommend any investments. We're not financial advisors here. We don't give any sort of advice or guidance. This is strictly for educational and informational purposes only. The information you can find here is all through public sources online. When you're looking at where to place your money, some people look at a risk pyramid. As you can see here, there is a variety of different places, different investments that you can put your money into. Most people would start toward the bottom. Starting at the bottom, you're going to see some very quote-unquote, I won't say safe, I'll use conservative places where the risk of principal loss is very minimal and the potential earnings, the potential return is very low as well. Where are we looking at? We're looking primarily at bank type of products. This is your checking account or savings accounts. Some would say bonds, as long as you hold the bonds all the way to maturity. CDs, or what are also called certificate of deposits. Treasury issues, some people would say those are very conservative places too. But the idea is there's a very low chance of losing your money. Now, as you can see here, and you can find these risk pyramids all over the place. This is a pretty detailed one. There's some more that's pretty generic. But as you slowly start to go up the pyramid, you start to see other types of places to put your money, which will include higher and higher areas of risk. Now, as you go up, there are primarily more bank type of products in this second and third tier. But then you start to get into some mutual funds, which are just pooled investors getting together to buy a bunch of different stocks or bonds, hoping to kind of hedge their risks a little bit. Then you start to get into some individual stocks, individual bonds, collectibles, speculative investments, etc. And then lastly, of course, this pyramid would say penny stocks and commodities. However, one thing I note that commodities, some would say would consider gold and silver. I would argue that gold and silver would be at the bottom here as a pretty safe place long term, and I hate saying safe, I should say conservative place to put your money, so that long term it generally goes up, but not as much as some of these higher risk assets. Another slimmed down version of the exact same pyramid, cash and cash equivalents. Again, the blue one is going to be different bank type of products or bank type of accounts. Moving up into the yellow, you've got other sorts of investments that you need to trade on some sort of exchange. And then at the top, you have stock options, futures trading, collectibles, and cryptocurrencies. But of course, as you all know, where my beef here is with cryptocurrencies is there is Bitcoin and there is everything else. And if you do your research, I would argue strongly that Bitcoin should be closer to the cash equivalents and in the bank type of products over the long term. Now, when you're looking at where to place your money, a lot of folks would say start out at the bottom, build a good foundation, get a good emergency fund built up. In the event of something happening, you have that cushion to fall back on. And then as you start to get more and more comfortable with where you're putting your money, more and more comfortable with long-term savings and long-term planning, then you start to move up this pyramid a little bit. After you have stepped away from the cash equivalents, bank type products, and you start to get into the investments, then you start to take a look at, well, what are the risks involved and where I can put my money into different asset classes. Again, this is public information. You can find us at jpmorgan.com, but this will show you a variety of different places to put your money. Again, we'll use cash as a starter point. 2008 cash did pretty good. 1.8% return. Then over the next handful of years, as the market and different investments performed well, You can see toward the bottom, cash did not perform as well compared to other areas to put your money. You can see some of the more aggressive places to put your money would consider REITs. Those are also real estate investment trusts or mutual funds that primarily focus on real estate. Large cap stocks, small cap stocks, some would argue international stocks. But the higher the risk on that scale, the higher the potential for return. But when the market is down, you can really start to see some pretty big dips here, depending on which asset class you're a part of. Now, oftentimes when you're investing, it's very difficult to pick the best horse in the race. As you can tell from this graph, if you had to pick one color along the way, it may or may not perform very well. So a lot of people would argue you should spread the risk out over a variety of different places. And you can see that's where this line in the middle is here with this white to show what a asset allocation or a diversified portfolio or a blended portfolio might look like if you picked a variety of these different places to invest. That way it smooths out the returns over time. The highs won't be as high, the lows won't be as low. Generally speaking, you'll be a bit more comfortable, and that's what most advisors, most financial channels, most talking heads in the financial world would recommend. Somewhere around a 60-40 portfolio, 60% being in stocks, 40% being in bonds. Again, I'm not recommending that. There's more details here at the bottom of what their models would look like. But a 60-40 portfolio tends to be the most commonly discussed portfolio that's out there. And lastly, to drive this home, we're going to take a look at the same deck from JP Morgan. This is giving us different returns for different asset classes. It's focusing today on stocks in the green, bonds in the blue, and then that 60-40 portfolio that I mentioned. These returns go back all the way to 1950 to last year of 2023. And you can see in any 1 year, this is a calendar year, if you were 100% invested in stocks, you could be up as much as 47% or down as much as 39%. If you're all in bonds, you can see here as well, a 43 down 13, and a 60-40 blend is in the gray. 1 year is not a lot of time in the markets. You've got some pretty large swings. But as you start to average out some of these returns, you've got a 5-year rolling, a 10-year, and a 20-year rolling, you can see there's a possibility of taking on slightly less risk by blending things together, but getting a similar return along the way. I hope you enjoyed the video today. We're really going to start to get into some of the meat when it comes to financial education. I know a lot of folks kind of get bored in the budgeting area and really want to focus on the investment side. So I'm glad we're able to finally get here in the calendar this time of the year. If you like the channel and you want to support it, please make sure you hit the like button below, subscribe if you want some more content, and hit the bell notification so you get notified every time I upload content. Thank you so much for watching. As always, stay inquisitive, stay informed, and stay subscribed for more. We will see you next time.